Hello traders, and welcome to this week's Forex Market Review. This week, the market saw an extreme reversal. At the beginning of the week, Middle East geopolitical tensions eased, risk sentiment warmed up, and non-US currencies collectively surged. In the second half of the week, as the Fed's hawkish resolution landed, the US dollar regained strength, and non-US currencies quickly retreated. Today, combined with currency strength monitoring charts, we will comprehensively sort out the weekly performance of all currency pairs, and then deeply dissect the driving logic behind the core currencies. This week, we focus on the euro, which saw the largest volatility. 1. Overview of weekly major Forex currency performance. This week's overall market can be summarized in one sentence. The US dollar ended strongly alone. Non-US currencies rose first and then fell, and the euro's volatility ranked first by a wide margin. The US dollar was the undisputed strongest currency this week, with a final weekly strength value of 142, consistently leading all monitored currencies. In terms of trend, the US dollar experienced a brief pullback at the beginning of the week due to the impact of the US-Iran peace agreement, but quickly stabilized and rebounded. After the Fed's resolution landed, it accelerated its strength and steadily maintained a high range in the second half of the week. The whole week presented a pattern of dipping first, then rising and ending strong, serving as the core pricing anchor for all non-US currency movements this week. The weak camp this week was very clear. The Canadian dollar once again became the worst performing currency of the week. As can be seen from the line chart, it traded below the zero axis throughout the week, hitting a stage low midweek with extremely weak rebound momentum. The Swiss franc followed closely. As Middle East geopolitical risks eased, the Swiss franc's safe haven buying significantly faded, and combined with the pressure from a stronger US dollar, it lacked effective rebound momentum throughout the week and remained under pressure. The euro was the currency with the most intense volatility and the most concentrated fundamental conflicts this week, with weekly volatility far exceeding all other currencies. It walked a standard roller coaster trend, completing a full long-short switch from rebound highs to pullback within a week, and the driving logic behind it is well worth deep exploration. Among other currencies, the British pound, Australian dollar, and New Zealand dollar also generally showed a trend of rising first and then falling, but with relatively moderate volatility and no independent major trends. 2. Dissecting the fundamental logic behind the euro's roller coaster ride. Early week period, June 15th, June 16th. The US-Iran peace agreement landed, risk sentiment warmed up, driving the euro to rebound passively. The euro's rise at the beginning of this week was entirely a passive market driven by external sentiment. According to a report from investing.com on June 15th, the United States and Iran reached a temporary peace agreement. Market risk aversion significantly cooled. The US dollar's previous wartime premium quickly faded, and non-US currencies such as the euro and British pound collectively rose to more than one-week highs. On June 16th, the market continued to digest the peace agreement's positive news, risk appetite continued to rise, and the euro extended its rebound trend, surging all the way to the weekly high on Tuesday. However, this rally was entirely driven by a weaker US dollar and sentiment repair, with no substantial positive developments in the euro's own fundamentals, making the foundation of the rally very weak. Midweek turning point. June 17th, June 18th. The Fed's hawkish resolution landed, policy expectations reversed, directly crushing euro bulls. This was the core turning point of the entire week's market. On June 17th, the Federal Reserve announced it would keep the benchmark interest rate unchanged, but released a far more hawkish signal than the market expected, explicitly hinting that another rate hike was still possible within the year. After the news landed, the US dollar rose nearly 1% on the day, related reports directly pointed out. The Fed's hawkish stance completely overwhelmed the optimism brought by the previous US-Iran peace agreement, and the US dollar reestablished its high position. Previously, the market had been trading the convergence of European and US monetary policies logic, the ECB raising rates and the Fed cutting rates, with narrowing spreads being bullish for the euro. But the Fed's statement directly reversed expectations. Not only no rate cuts, but instead opening the door to rate hikes. After the rapid reversal of expectations, euro bullish funds exited en masse, and the market plunged directly from Tuesday's highs, giving back almost all of the early week's gains in just 2 trading days. June 19th, June 19th, June 20th. The Fed's hawkish expectations continue to ferment, combined with renewed uncertainties in Iran negotiations and the widening US. European interest rate spreads suppressed the euro's rebound. This was the core reason why the euro remained under pressure and was unable to rebound at the end of the week. According to related reports, the Fed's hawkish interest rate outlook continued to ferment, and the US dollar maintained near one-year highs. Meanwhile, Iran negotiations showed signs of breaking down, and Middle East uncertainties rebounded, further boosting the US dollar's safe haven buying. During the same period, although Eurozone bond yields rose slightly, they completely failed to keep pace with the upward rhythm of US Treasury yields, and the US-European interest rate spread continued to widen. Under the suppression of the spread logic, EUR-USD lacked rebound momentum and could only oscillate at low levels, thoroughly confirming the week's rally then retreat trend. Summary of underlying internal logic. The euro's ultra-high volatility this week was essentially a sentiment round trip driven by external macro events with 2 core logics. First, passively following external logic throughout. It rose due to passive lifting from geopolitical easing and a weaker dollar, and fell due to passive pressure from the Fed turning hawkish and a stronger dollar. No fundamental events occurred within the Eurozone itself that were sufficient to change the trend. Second, the foundation of the rally was weak, making the reversal inevitably rapid. The Eurozone's own economic growth is sluggish, and the ECB has very limited room for subsequent rate hikes. The early week rally had no support from its own fundamentals, driven only by sentiment and a weaker dollar. Once the external logic reversed, the market quickly fell back, ultimately walking a roller coaster trend of how it went up is how it came down. 3. Weekly review and outlook. Overall, the core contradiction in this week's Forex market has officially shifted from geopolitical risk game to Fed policy expectations. The US dollar has regained market dominance through its hawkish resolution. Its short-term strong pattern is hard to shake, and non-US currencies as a whole will remain under pressure. Next week, we will focus on tracking the Mizi statements from Fed officials, as well as Eurozone inflation and economic data to sort out the market's mainline for you as soon as possible. That's all for this week's market review. Thank you for watching and see you next time.